start slowly, and then as more people come in, I guess I can repeat if anything, if they need anything. All right, well, hello everyone that joined us. Welcome to the Universal Commercial Capital Interactive webinar. My name is Georgia. I'm an account executive, and I'm joined here today by our CEO, Eric Trend, and my colleague, Izzy Smith. We organized this webinar just to talk about the current hardships, to see what has changed in the market, what's going on in the private lending industry, and if maybe we can help each other with the problems we're facing. If any of you don't know, Universal Commercial Capital is a private lending company. We're located in Huntington Beach, California, and we specialize in fix and flip, hard money, and commercial loans, but we also have a lot more programs, which you will hear about in a couple of minutes. And I just wanted to let you know, during the webinar, at any point, feel free to ask any questions you have and write them in the chat. I will be reading them out and you will be getting answers really quickly. So since it's interactive, don't be shy. We will make sure to answer any questions you have. So that will be all for me for now. And let's take it to Izzy and see what she has for us today. Hi, Izzy.
Thanks, Georgia. Hi, everyone. Good morning. I'm Izzy, and I work as a loan consultant in Universal Commercial Capital. I'm going to share a PDF with you so you can find it in the chat box, and you can learn more about products later. We're going to talk today about funding during this shifting market and during economic crisis. What we are going to focus is on our programs and how they actually have changed, so you can still close loans with us and to make profit. Georgia?
All right, let's just see if the PDF is popping up in the chat. Yeah, and while you're sending that, let me ask you, so I mentioned hard money and the fix and flip. Can you maybe tell us what are the differences between those two programs? Because sometimes people mix them up. So,
oh, yeah.
Yeah.
Yeah, you bet. People are calling me and asking, hey, can you do hard money in Florida? Well, I said, okay, I cannot do it. I can do hard money only in California. But tell me more about your deal. And when they start talking, I realize they need fix and flip. So people are not getting what's the difference. And I would just do a quick highlight, hard money we can do only in California. And we used to be able to fund more than LTV than we are now, but we are still able to fund 70% of LTV, up to 70% of LTV. So, but we became a little bit picky on these hard money deals, and just for you guys to keep in mind, we are going to look into location. So we are not happy with deserts and things like that. And we are going to check the property itself and asset.
Right.
And for fix and flip, we are still able to fund nationwide. We ask for documentation. We ask for FICO score. Like it's not case with hard money. We don't look into credit score, but we ask for minimal documentation. And for a fix and flip, we are still able to tailor our rates and terms, and they will depend on your experience and the deal itself.
All right.
Okay. So let me come in a little bit in here. You know
Yes,
what? Between the hard money loan and the fix and flip, the key difference is hard money, there is no construction element involved. Like people has a bad credit, some reason that they cannot get a conventional loan, they go to us for the hard money loan. And for hard money loan, we mainly look at two things only. First, the asset, the equity in the property. Secondly, the location. Before, we used to fund everywhere in California. These days, we try to stay away from like remote area. Remote area means city, town with like population of 20,000 or under, or like up in the mountain area. So that's for harmony. For fix and flip, there is always a construction element involved. What do you fix? What do you rehab? And we look more than just the equity in the deal or the location. We also look at the borrower FICO score, experiences, and reserve. Reserve means your cash in the bank. Why? Just something happened, does the borrower have the ability to go on? So basically, that is the two main difference between harmony and fix and flip. Rate-wise, it's pretty close. I would say it's in the 10% to 12% range right now. Fee-wise, it's pretty close too. Normally, for fix and flip and for harmony, standard fee is 2% plus any third-party fees. Back to you, Georgia.
Okay, thank you, Eric, for that explanation. Before we continue, I just want to say to the people that just joined us, feel free to write any questions that you may have, because this is an interactive webinar, so we would love to talk to you also. Write them in the chat and I will read them out and we will answer them. All right, Izzy, would you mind just going to the slide for the commercial, and let's talk a bit about that. And is the commercial program still good these days?
Well, I would say that we advise our clients to do their own math, because rates are not super great right now. Their rates are in nines. And since we are doing commercial 30-year fixed, so we really want them to double think if they want to marry with that kind of loan with rates in nines for 30 years. So if they'll make sense, if they're still making revenue, of course they will do it. But we just want them to be super cautious and to think twice about it. Eric, would you like to add something?
Yeah, sure. Like, what
Thank
is
you.
commercial? Commercial loan, put in a very basic terminology. It's a rental income property. So for rental income, what buyer, borrower looking for? The yield from their investment. With rate at like 6%, 5% before, people make some good yield, make money. Rate for like commercial loan right now, commercial loan mean loan for office, retail center, apartment, rental, single property. And with rate goes up to like at least 9% right now. A lot of time, investors do not make money anymore. So why should they invest? So the key is whether it's still beneficial to purchase some property or refinance with the cash out at 9%. So it all depends, but rate up from 6% to 9% for commercial loan right now. I see a lot of people kind of sitting on the sideline right now to purchase, but like there are still borrowers who want to do some cash out from their property and take advantage of any downturn in the price in the market right now. Or we still see clients that they have to refinance their loan just because it's due and mature. You know, those loans like 30 years due in 5, 30 years due in 7. A lot of time people say, I have to go to you because my bank stopped doing commercial loan. You know, nothing wrong with my loan, nothing wrong with my qualification. They just stop. So except on the purchase market, we still see a strong demand for commercial loan. from people who want to do some cash out to do more investment at this softening market, from the people who have their loans mature, have to pay off anyway. So back to you, Easy.
Well,
All
yeah.
right.
So I would just wrap it up with this commercial loan. Yes, we can do purchase, refinance, and cash outs. As Eric said, cash outs and refinancing makes sense right now to do.
Okay. And let's see, what about our DSCR loan? And how does it differ from the commercial loan? Because are there differences, and how is it better than the commercial loan?
Okay, that's a great question, Georgia. Thanks. Well, I would tell that DCR is the subtype of the commercial loan. DCR stands for debt service coverage ratio. So what we will do, instead of standard debt to income test, we will qualify your income based on property's cash flow and of course on your credit score. So this is a great product for investors. And what I really love about this product is it's 30-year fixed, but we can do it 5 or 10 years interest only. And this is another thing that makes sense in this shifting markets right now to do. Eric,
Right.
would you like to add something? So I'm asking Eric here to elaborate on this because he has been 24 in the industry, and this is my first webinar. So I just want to give put Eric on his spot, and he will clarify everything for you. And
Sure.
I would just just want to thank him for this opportunity to work with him.
Okay. Oh, you know what, with this DCSR program, I think the only thing we need to explain to our audience more is the DSCR 0.75. What is it? What is 0.75? You know, okay, first of all, DSCR means you cannot be qualified with your personal income for this loan. So since it's an investment property, we're going to qualify this loan on the income generated from the property itself. So that's the word DSCR means. It means we take the net operating income, gross income, subtract tax, insurance, association, whatsoever, and we divide it by the PI, principal and interest. And it has to be at least 0.75 or higher, which means 0.8, 0.9, 1%. It cannot be lower. If it's the higher, the better. Under 0.75, we cannot do the loan. So in a sense, it would take 0.75 of the net operating income to service the loan. That is the minimum. And like I said, the higher, the better. And if the DSCR is higher, supposedly 1%, 1.1, 1.25, we might be more lenient on the LTV. Instead of 80%, we might go up to 85%. We might be more lenient on the interest rate. Maybe we give the borrower 0.25 break in the interest rate. And sometimes people say, I'm not sure on the tax and on the insurance yet, you know, to figure out the net operating income. Rule of thumb, if you don't know, take 60% of the gross income. That is the net operating income. Normally, it would fall within that range. So 60% of the total revenue you receive for the property is a net operating income, and divided by the mortgage payment, PI only, principal interest. And if it's 0.75 or higher, we have a deal. If it's under, the loan is dead. I think that is one thing I want to explain more to our audiences.
Okay. And while we're on this topic, could we maybe get a formula? We have a question from Hans Acosta. The formula for the DSCR. Can either of you? Yeah, let's hear about the formula.
Say like we have a single family. you know, the rental income is $1,000 per month. That is the rental income the landlord will receive. But he has to pay tax, he has to pay insurance, he has to pay some maintenance on the property. So for net operating income, we only take 60% of that 1,000, which means we're gonna use $600 per month as the money the borrower will have to pay the mortgage payment. So suppose we're gonna go 80% LTV, 80% of, let's say value is $100,000. So we're gonna loan the borrower $80,000. And at 9%, I believe the monthly mortgage payment would be around $750. Okay, your net operating income is 600, and you divide by 750, which is the principal and interest payment. Let me see, what is the DCSR in here? 600 divided by 750. So it's going to be 0.8. So in a sense, it's over 0.75, the DCR ratio. So we will fund the loan. We will do the loan.
Okay, well, thank you so much for that. I'll just write the formula here. And thank you so much for the explanation. I'm sure it's much easier to understand it that way. So this would be the formula. And we also have one more question. Let me just...
Hey, I would like to jump in, and I have a great news for investors. We don't ask for your tax returns for DCR.
Right.
All right. And this is a great question. So do we lend out of state, for example, Nevada?
Okay, for fix and flip, we can lend nationwide, but not Nevada, Oregon, and Arizona. The reason why is those states require a physical location in order for us to fund any loan. Not only the license in the state, but we got to have a physical location. So to answer that question, do we lend in Nevada? No. Besides Nevada, Arizona, and Oregon, do we lend in other states? And the answer is yes.
All right, well, thank you. Thank you for that answer. All right, well, while we're on the topic of our programs, Izzy, is there any programs that you would like to mention? Example, if somebody has no documentation or cannot provide it for us, do we have a program for that?
Well, we do have more programs. We haven't mentioned ground ups. We haven't mentioned no doc program, light doc program, and we have a bank statement just for commercial.
Okay. So let me clarify on the bank statement program for commercial. For commercial loan, there are two types. Either you, the owner, gonna use it themselves for their own business, or they're gonna rent it out. Okay, if they rent it out, we're gonna use the rental income to qualify, which we call the DCR program. But there is some case the borrower gonna say, I'm gonna use the property myself for my business. There will be no rental income. So our question is, so how, with the rental income, at least we know what you receive every month, you know, so you can service the loan. But if you use the business yourself, how do we know you have the ability to pay the loan? SBA lender, which is a government guarantee lender, they require your business and your personal tax return to make sure you have the ability to pay the loan. A lot of time people say, well, the income on my tax return is not enough. So SBA is out because I don't have enough income on my tax return to qualify. For us, okay, we find another way. to see whether you have the ability to make payment on the loan. How? We're going to ask for 6-month business bank statement. From the deposit into that account, we can apply, figure out your revenue per month. I mean the deposit, not the balance. You know, you can deposit $100,000 in your business bank account. You're going to spend $95,000. The balance left only $5,000. We're not going to look at the $5,000. We look at the $100,000 revenue that you deposit into your bank account every month. And if that deposit is good enough to service the loan, then we would approve the loan. Then we can bypass the personal and the business tax requirement. Okay, back to you,
Yeah.
Izzy.
All right.
I would just add here that we need the property to be 75% occupied. If it's only owner occupied, we are asking for 51% to be owner occupied with their own business. And they can have like 50% owner occupied and with their business and 50% of rented. But what we cannot do is property cannot be vacant.
Mm-hmm. Okay, so for vacant, so what if people say my property is vacant? Any other option? With us, only in California, we have to go with Harmony.
Correct, yeah.
Harmony, it can be vacant, but like when we get into a regular commercial loan, normally not only no vacancy, but we want to see the tenant to be in the building at least 3 months.
Correct.
You know,
we have a seasoning period of 90 days.
90 days, because a lot of time we have a client, they have a fix and flip commercial property, they just fix it up, but it's still vacant. You know, and they just sign up the lease in November, in December. So we want to see a 3-month seasoning in those leases before we fund the loan. For apartment complex, you know, we prefer to see at least 80% occupancy at the time of funding. Same again, you know what? Some investor, they come in, they bought a property, you know, it's like 50% vacant because they have to do renovation on those 50% of the unit. By the time they're ready, they want to apply for the loan, get the money out and pay off whatever loan they had before. But, you know, 50% is under our 80% threshold occupancy. Then they have to wait until they get up to that 80% at funding. The seasoning is at funding, not 3 months like a commercial property. So I hope I'm clear on that point. Back to you, Izzy.
Oh yeah, I would just add generally, we will ask for 12 months business bank statements. So they're business bank statements, not your personal bank statements. And max we would do with bank statements is LTV 80%.
Mm-hmm. Okay, so back to like the topic of our webinar today. Are we still funding loan these days? If we don't, what type of loan we don't fund these days? You know, what type of loan we pull away from these days? And if there's any changes in our approval process, what is it? So to ask is to answer. Let me answer my own questions in here. Okay. With all the change lately, with like the rates going up, all the talk about we're gonna run into the recession, the crisis in 2009 gonna repeat itself. So all lenders, all investors start getting nervous. Okay, what in the future? Will value go down? Maybe it will, maybe it will not. As a precaution measure, all lenders across the board cut down on their LTV. We are still funding loans, but we cut down on the leverage. In a sense, we ask the borrower to put more money into the transaction. For fix and flip, if we have a seasoned borrower before, we can do 90% of the purchase price or even 95% of the purchase price. 100% rehab. Now we are pulling back to 80%. For some borrower, no problem. I'm going to put up 10 more percent. I don't have any problem with that. Some say I don't have enough money to put down another 10%. So that is the change. The one thing change. Before, you know what? In the fix and flip space, there is a lot of like first timer. You know what? I've been working with this contractor for a long time. Now I want to do fix and flip myself. You know, I don't have any experiences myself before, but I do have experiences working with someone. Normally, before we okay with that, we just ask for like 20% down payment at least. Right now, unless, you know, is strongly established that this borrower has some real experiences before, likely we're going to pass on it. So the group going to be affected is like first timer, and we have a lot of first timer. Everyone want to get to the game. Oh, I want to do fix and flip. You know, I found this property. It's great. You know, I've been working with someone else. So that is a second change. But the bottom line is just the LTV is cut down, you know, around 10% these days, around 10%. Whatever 90% right now, before it's 80 now. Whatever 80% before is 70% right now. The good thing is, up till now, things doesn't look as bad as people thought. So the lenders have a tendency to start losing up again right now. You know, for the last crisis, it is a liquidity problem. No money in the market. This time, there is still plenty of liquid in the market. Companies still have money. Consumers still have money. Consumers spend record on Black Friday this year. So in a sense, I think the correction this time because of the too hot market, not because of any fundamental structural problem like the last time. So if it's a correction to the red hot market, I believe all lenders gonna loosen up and go back to their underwriting guideline the same as before. So around January, February, I would say lender would start losing up on their underwriting guideline. The scariest moment is over. September, October, you know, people talk about property value gonna go down. It's not crazy anymore, but it's not going down. Value still hold, but it's not crazy anymore. Like listing price 1.3, I have 20 offer for 1.6, no more. But if it's 1.3, give it a month, they still offer. So that is my opinion on the
Your
change.
prognosis is that it's gonna get a bit better, right?
I think it not like a little bit, but a lot better. Because first thing first, there's still money, plenty of money in the market for both investor, lender, and the consumer too.
Sorry to interrupt you. We have a little trouble seeing you. Okay, great. Yeah, so yeah, I had trouble seeing you. Yeah, I completely understand what you're saying.
Yes, consumers spend record money during this Black Friday.
Yeah.
Unemployment still very low, still very low. So I think the trend is not going back to like 2009, but I think there is a correction on the way red hot market, crazy market. So for real estate right now, if you price it correctly, reasonably, you still can sell. But I know more like listing price 1.3 mil, and there are 15 offer or cash at 1.6 mil. That time is over.
Yeah. And let me just jump in real quick. We have a question that I assume can be answered really quickly. We have a question from Brian Wong, and he's asking if we have prepays for DSCR.
For the DSCR program, for
Mhm.
all the regular commercial loan program, there's always prepay. 5 years prepay. Step
5 years,
down.
all right.
4,
Yeah.
3, 2, 1. Always prepay. Can people buy out a prepay? 1 point for 1 year. But there gotta be minimum 1 year prepay anyway. You cannot buy out totally on the prepay. So once if you get into a regular commercial loan, keep in mind there's always prepay. Minimum 1.
And you said you can buy it out after 1 year, right?
No, you can buy it out of prepay, but there is still always 1 year prepay, no matter what. And how much is the prepay? 5% of the balance of the loan.
All right, thank you for that.
Mhm.
And let's see, let's ask one really simple basic question. So let's say if somebody wants to send us a scenario, what are some initial documents that we would need for them to submit?
Okay, it depends on the loan program. How many all we need to have in the beginning is the property address. From that property address, we're gonna check on value right away. Then we kind of know whether we can do this loan or not. You know, we can check on the value, the equity in the property, the location. That's for Harmony in California only. For fix and flip, first thing we need is full application. Who are you? Secondly, we need credit report. We need minimum 650 FICO score to do the loan. Sometimes we can go down to 620, but don't count on it during these days. Thirdly, we need to see a budget. Okay, fix and flip. How much is a fix? How much is a fix? And we need it itemized, not only, oh, I'm going to spend $50,000 on the fix. Itemize, 5,000 for concrete, 10,000 for framing. Thirdly, you know, we're going to do appraisal, but we need the borrower to let us know the after repair value. After you fix it, what is the value you think it would be? Those are the basic information we need to have before we can move forward. We can move forward. For like commercial, you know, for like on regular commercial loan, since we rely on the rental income from the property to qualify, first thing we need, beside the loan application and the credit, the rent roll and the operating statement. The rent roll means how many tenants you have. The operating statement means profit and loss. You know, revenue against expenses, how much you collect, how much you spend, the net operating income. Without it, we cannot go further because we need to know the income of the property. So those are the basic requirements we need to have in the beginning, you know, to give our client a more accurate answers. Without that, sometimes, you know, the answer will not be accurate just because we don't have enough information.
Yeah, of course, we do need to have enough information to answer. Yeah. All right. And let me ask you, we have another question from Hans. He's asking if the property is in distress with NOD, TS, or BK, how do we deal with that?
Okay, for our Harmony.
If we're having a little problem seeing you, so feel free to sit back. Yeah, great. So we can see your face. Okay, wonderful.
You know what? If it's okay, a lot of people, they found they have a notice of default, NOD, you know, and they file for bankruptcy to buy time to work on the notice of default. So do they have any option about getting a loan? Yes, our Harmony loan program, but only in California. You know, we have program for that situation. We call it foreclosure bailout. We will do up to 60% max of the property value. That's the only thing, you know, 60%, but we will do it. We call it foreclosure bailout. Recent bankruptcy, you know, yeah.
Okay, thank you, Eric. Hans, feel free to follow up if you need any more clarification or you want to follow up on that question. And let's see, if we have foreign nationals, how do we deal with that? Can we lend to them? How much? And it doesn't matter on which property it is.
Easy. Do you want to answer this question?
Sure. Yeah, we still lend to foreign nationalities, but we ask for minimal documentation from them. So they need to have proof of social security number, or they can apply through their office, the closest office. Once they got that certification, it takes up to several weeks. We can work with them.
Okay.
Okay,
So
that's great.
for foreign national program, these are the basic things that we need to remember. First of all, we only do max 60% LTV. And by foreign national, we mean people from overseas. They don't live in the US, they don't work in the US, they don't have social security number in the US. They are from Europe, they are from China, from India, wherever. That's foreign national.
Okay, Eric,
So-
but can we find people that work here? They don't have US citizenship, but they got like security number because they have a job here.
Yeah. So those people are considered not foreign national. because
Okay, I was thinking of them.
they file tax in this country. The only thing they don't have is the legal immigration status, but they have everything else. They have
Yeah.
a social, they have a job, they file tax every year. So they are considered regular borrower, not foreign national. Foreign national means an investor from Europe who come here and they say, I want to buy rental property in the US for my investment. Means, you know, customer from China who come here, I want to buy a house for my kid who go to college in here. They don't have anything in this country. That's foreign national. Key thing, first thing, they have to put down 40%, which means maximum 60% LTV. Their down payment has to be in a US bank in the US. You know, because they can transfer money from overseas, but we don't want to get into all the problem, you know, with the government on the source of money. So we want them to open an account in the US, put their down payment in there. Thirdly, we need them to have a visa, minimum a tourist visa. A tourist visa. It doesn't have to be any immigration status visa. A tourist visa is fine. Fourthly, you know, if they are in China, in Europe, how do they sign all the paperwork, the loan document? For foreign national, we allow them to sign the loan document in their own country as long as they sign in a US embassy and notarized by a US embassy personnel. It's allowed. You know, I have a lot of clients from China. They are busy with their business. They cannot come over here to sign the paperwork. They go to the US embassy or consulate in their native country and sign the paperwork. It's allowed. So those are the basic answers for foreign national loan program.
Okay, well, thank you so much. And I actually have a question because I have been with the company for a few months, and usually when I tell somebody that we need an appraisal, they get worried or confused as to why we would need it. So my question would be, do we always require it?
For Harmony, no. Sometimes we do, sometimes we don't. Why? Because for Harmony, it's our own money. You know, we can decide on whether we need the appraisal. Sometimes it's unclear on public record. We're not sure about the condition of the property. We're going to ask for the appraisal. For all other programs, we always need the appraisal because for all the loan program, we're going to sell it to the secondary market. and our institution investor from Wall Street, such as Morgan Stanley, those investors, they always want an appraisal. So we gotta have it.
Yeah, of course. And what about second TDs? Because I've been getting a lot of files with second TDs. So is it tricky? Can we always do second TDs or never? Where do we stand on that?
We can only do second TD in California.
Mm-hmm.
Yeah, only in California, and maximum by LTV is 60%. And the reason why not too many lenders do second TD, because if there's a problem, the second TD got wiped out.
Yeah, I understand. Yeah, usually because people are confused why we cannot do it. So I was wondering about that. Yeah, and you were mentioning easy owner occupied. So if it's if the property is owner occupied, can we still do a loan?
Well, I was mentioning owner occupied in regards to commercial bank statements. So that means that the owner occupies property with his own business. But when we are talking about residential, Eric decided to call off from doing owner occupied properties that we used to do.
So in a sense, we don't do own occupy for residential property.
Correct.
Just because, you know what, the disclosures, the requirement for owner occupy is very different from like non-owner or investment property. Okay.
So yeah, I would just say that we are doing only real estate investment properties right now. Okay.
So Joshua, to sum it up, why don't we go into the Q&A question right now?
So, all right. So we were going through the questions as they were coming in. If anybody else has questions right now, feel free to type them in. I'll give you a minute just to give you time to write them out. And also, if you have more elaborate questions, follow-up questions, or if you would like to keep in touch with us, I did write down the email you can reach me at, and also my number. Izzy can also write down her email if you want to reach her, and also her number, just for the future.
Okay. Sure.
Yeah, just so they can reach us. And also, I did promise Hans that I will send him information regarding the guidelines for the foreclosure bailout. So you can count on that. As soon as we're done with this webinar. Let's see if anybody has anything they would like to ask.
So our audience have our email, our phone numbers. Please feel free to
we're writing. Yeah, they can reach out.
You know, we are always here to answer your question first.
Yeah.
Okay, and if there are no other questions, Joshua, you know, you can call it a webinar.
Okay, so thank you everyone who attended. You can find the information in the chat. As I said, our info is there. Feel free to reach out anytime. We're available. We do respond to emails pretty quickly, and also we tend to give soft quotes out in under 24 hours if we get all the information that we need to give you a soft quote. Let's see, Brian. No, thank you, Brian, for attending. I hope we answered everything we could. And as I said, feel free to reach. Okay, so I think that will be it from us today.
Thank you for attending.
Thank you, Eric. Thank you, Izzy.
Thank you.
And we will send out, if you had any more information for the upcoming webinars, we'll reach out to you and let you know. So that will be all for today. Thank you, everyone.
Thanks,
Goodbye.
Easy. Yeah, bye-bye.
Bye-bye. Thank you, Eric.